anyone in the U.S., happy early Thanksgiving. Quickly on the call today, we've got Will Hares joining us from London, swinging across the pond. We've got Scott Levine in 731 Lexington in New York. We've got Talon Custer in an undisclosed location in New Jersey with a nice um, bookcase over his shoulder. And we've got Fernando Valle joining from Long Island, I believe. So, uh, thank you for being here. I think we're going to have a lively discussion across the team. Just a reminder that we are doing these weekly now so that we can get broader exposure to all of the analysts who help support the work that we do here at and so, Scott, I want to come to you first. We've had a number of interesting conversations here recently, but I know the last time we spoke, your earnings cycle wasn't completely finished yet. And I think that one of the things we've had an ongoing discussion about is what's happening in the U.S. shale patch, what's going on with drilling. So, give us your latest readout of where shale may be headed in 2024.
Sure. So, the last company to report was Helmerich and Payne. They're the largest land driller in the U.S. And, the first two, we kind of had a mixed read from Nabors and Patterson. Patterson, I think, probably a little bit more conviction in a recovery than what we saw out of Nabors, where we saw more mixed results and guidance for a modest decline in the rig count here in the fourth quarter. All the companies expect it to be up next year, but then again, all three were overly optimistic this past year, and that's often the case. And so, if anything, I'd say H&P, probably reinforces confidence that we will see stabilization at a minimum in the fourth quarter, if not an increase. And they're, calling for an increase, I think, of like, mid-single digits in terms of the number of additional rigs they expect to activate in the December quarter, and then additional gains in the first quarter. Our 2024 rig model, which we updated, I think, about a month ago, and may take another shot at here in our 24 outlook, we're calling for 700 rigs in service by the end of next year. We're currently sitting at about 616. That could be a little optimistic, possible, but it could be optimistic in light of what we've seen this year. And we'll see what comes with the outlook for oil prices. I'll defer to Fernando on that subject. We're still sitting in the zone there between 670 and 80, but still some uncertainty regarding the economy for next year, and some questions on OPEC, which I'm sure he'll address. But overall, I think probably 675, 700 is a decent number to think about for rig count for the end of next year. The last couple of weeks, we have seen stabilization in the U.S. rig count. We saw an increase of 2 rigs last Friday, and that's after, as I mentioned, maybe a 20% decline year to date, which has outpaced expectations to the downside. So all in, I think the incremental data point from H&P was positive, and they're the largest player in the U.S. industry, and the big three are about 60% of the market overall. So I think stabilization in the fourth quarter, recovery in the first half of next year, maybe a leveling off in the second half, and getting to 675, maybe 700 by the end of next year is basically what we're looking at.
Okay, thank you, Scott. Now I want to read across that into the broader oil market, and I think get commentary from both Will and Fernando. One of the lead articles on the terminal today related to energy markets is a story about Pierre Andron, who's basically made the argument that OPEC Plus may need to do deeper cuts, particularly given the resiliency of U.S. supply. So, Will, let's come to you first. And what's what do you make of where the U.S. shale patch may be headed, and how do you think that feeds into the OPEC plus narrative?
Well, I'll leave the outlook for U.S. Shale patch to the American guys on the call, but I think additionally, from you mentioning one of the top oil stories on the terminal, we've recently received that OPEC has delayed its meeting, which was originally scheduled for the 26th of November, and they pushed it back. It looks like by 4 days, and the apparent read-through is that the Saudis are getting a little bit uncomfortable um, with their lead role in these unilateral cuts that they've made, and I think the possibility here is that this is a pressure move on the remaining members of OPEC that Saudi wants them to cut additionally, given the pain that the Saudis are taking, and particularly against a weak economic outlook, of the resiliency of U.S. shale, and contributing to what looks like a surplus in the first half of next year, which I believe is mostly underpinning that thesis from Pierre Anderon, that not only do OPEC need to extend these cuts into 1Q, but possibly even deepen them as well, because we are close to that rumored $80 price floor that many think OPEC is trying to establish and protect.
Fernando, over to you. What do you make of all this?
Yeah, I think ultimately it just shows that production cuts don't really work, right? And you're building spare capacity that can come back within 45 days. And our thesis has always been that you can't fight the Fed. Doesn't Saudi's balance sheet's not bigger than the Fed's, and they're not going to. And the problem is, as you push past $90, consumers are saying, I can't afford this. And so refiners are cutting back, and you have all the other issues. And frankly, they may not be able to afford it at 80 either. Not in the current situation of fiscal issues. You see Germany trying to rebalance its budget at lightning speed. The U.S. obviously fighting a debt ceiling after the other to avoid a government shutdown. So I think our issue has always been demand, and it doesn't really matter how much they cut, because we need to figure out we need to rebase our spending power. And so from that end, I think they're trying to catch a falling knife, and it's not going to end up well for OPEC. And if Saudi is struggling, could you imagine what Libya and Iraq are doing if they actually met the production quotas? I mean, they don't have the same balance sheet as those countries. So this sounds eerily familiar. 2013, 2014, when essentially OPEC disintegrated. Russia's fighting a very costly war. They're not going to cut either. So it seems like a moot point, and that's why Brent's off $3 today, because they see that if Saudi is balking, the other guys don't really have an. They're not going to listen to it. Essentially, I don't think. And then ultimately on the U.S. shale patch, I think Scott gave a good lay of the land, but one thing I'll say is that the mega mergers are probably mean some capital rationalization. You'll spend less as Exxon Pioneer and as Chevron Hess than you would as standalone companies. And then some of the privates, we keep hearing that their cost to finance is up significantly. Talon's and Scott's companies aren't giving them any price breaks or any significant price breaks yet. So they're struggling to make ends meet at $73, $74 WTI to warrant a significant increase in spending.
All right, very interesting. Thank you both for that very insightful commentary. I want to switch gears a little bit and bring on Talon on the gas side of the equation, because I think there are probably some analogs there. And I know that you put out a note very recently here that looks at gas infrastructure requirements and kind of where the U.S. would need to be spending in order to boost its role in the LNG market longer term. So, what's your sense on U.S. gas at the moment and how it fits in with the broader global gas equation?
Yeah, so that note focused on the fact that we need more infrastructure. U.S. LNG gets a lot of headlines because of the growth. It exported virtually none in 2016, and now it's the largest, and it's just going to continue to expand. So there were multiple projects that reached final investment decision. Last year we had 3 more this year. Our analysis shows that feed gas demand for those it's going to grow in excess of 12 billion cubic feet a day. And that's just with the ones under construction. It should be actually a lot higher than that, because I expect more projects across the finish line next year and the year after. So the question becomes, okay, how do we supply that? And if you have 12 plus billion cubic feet a day of demand coming online, there's only about 9 billion cubic feet a day of project capacity under construction right now in terms of pipelines to get gas to those terminals. And because the Gulf Coast is the focus there, it's mainly Permian, Eagle Ford, and Haynesville, right? So if you focus on the Permian, that's where there's a lot of takeaway constraints. Oil is sufficient at the moment, but gas, you can see it in the Waha Henry Hub differential. We need more capacity, and the Whistler expansion came online in September. We have the Permian Highway expansion coming online next month. And then you have a 2.5 billion cubic feet a day Matterhorn Express coming online in the second half of 2024, which is great. But even immediately after that, I think we're going to need more. And there's a handful of proposed projects, including, I think good candidates are Energy Transfer's Warrior Pipeline and Kinder's Gulf Coast Express expansion. But another interesting factor here is Mexico LNG. So you have the Saguaro LNG off Western Mexico, that it's an FID candidate over the next few months. And if that goes through, then One Oak Saguaro pipeline, which will go southwest from taking Permian gas to the border with Mexico, that's 2.8 billion cubic feet a day of demand there. So there's a lot of projects, a lot of things to look at in that area. But the bottom line is that we need more projects. And luckily, the jurisdictions in Texas and Louisiana are more friendly. But we're going to need a lot more infrastructure. And that also brings the question of production.
Okay, thanks, Talon. For anyone who hasn't seen it, there's a really interesting chart that's been floating around on Twitter on the composition of European gas supply, and it's from I believe ENER's chief economist, and it's what's most telling about it is that we kind of intuit the story, but in 2021 Russia was almost half of Europe's gas supply. You see it drop to about 25% in 2022. And then you see it fall off quite a bit more in 2023, although not completely to zero. And you see this reshuffling, but a big piece of that reshuffling is you see US LNG run from about 6% of the supply in 2021 to over 18% year to date in 2023. So Talon, one just follow-up question is, is US maxed out at the moment in terms of feeding into Europe, or is there more potential uplift, and what's the timing of that look like?
Excuse me. Yeah, so we actually saw the majority of US LNG is clearly going to Europe, right? But even in the second half this year, we saw a little bit of a shift. There was more going to Asia, because you can see in the JKM premium to TTF. JKM is the Asia benchmark, TTF is the European benchmark. But at this stage, US LNG is maxed out, and there's not too much capacity coming on in the immediate future. But obviously, that's going to change over the coming years. But there's only so much that the US can send out. And it goes where, the interesting thing about US LNG is how flexible it is versus other sources. So even though, roughly 90% of US LNG is backed by long-term contract, it's actually considered spot because a lot of it is contracted with portfolio players, which are just going to direct it to the highest bidder, which obviously has been Europe. So that's where you see that flexibility there, and also why you've seen some more go to Asia. But even with European storage at 99% full, you still see so much LNG going because they want to keep it as high as possible, right, and minimize those withdrawals. I think the key is always with this market is weather. If it's cold, obviously there's going to be more drawdowns and more LNG going there. But if it's warmer, maybe we see a little bit more going to Asia, similar to what we've seen in the second half of this year. Still the most going to Europe, but a little bit more going to Asia.
Will, I want to swing around to you on this question as well. You were quite early after the European gas crisis unfolded as sort of calling out the role that Norway could play, and specifically Equinor, in helping to meet some of the supply needs for Europe. And I guess the question would be, how important is gas to the European oil majors at the moment, and are they continuing to sort of optimize their portfolios to take advantage of this extreme pricing that we're still seeing in Europe, relative at least to the U.S. gas market?
Yeah, so Equinor is a very interesting case study in how the gas markets have evolved in the last couple of years. Obviously, it was the primary beneficiary from the energy crisis, and has pretty much maxed out now its production to continental Europe, just over 120 BCMs a year. There's not much further capacity that they can add to that. But yes, I mean, gas is incredibly important to the European majors' portfolios, and increasingly so. Although in the near term, and as we saw in 3Q results, we've seen the trading and optimization units for the European majors easing significantly. So these have been major contributors to earnings in the last year and a half, benefiting from some of that price volatility. But signals from management teams is that that level of earnings contribution, which they do not disclose, it's a black box, is expected to ease further as there's less volatility, given those super high inventories that Talon mentioned, unless there's the weather risk, obviously, and also potential supply disruption risk, which always is present. And we saw little flashes of that a couple months ago with some strike action at some LNG facilities in Australia. So gas is very important. For Shell and Total and BP, or to a slightly lesser degree BP, the gas units, integrated gas units, are the largest contributors to earnings for these companies, and they are growing their capacity significantly through major facility build out over the coming years as well. So gas is rising as a share of production mix, and as a share of overall earnings contribution, even though prices have eased substantially over the last 12 months.
Okay, thank you, Will. There's another story that's caught my interest on the terminal today. But by the way, if you're listening, you don't know how to do this, you can type top TOP space NRG, and then you'll pull up the sort of curated list of leading energy stories on the terminal for the day. And one of the ones that I think could get some good discussion here is this idea that there's a group that is called Climate Analytics, and they're basically predicting, they say there's a 70% chance that greenhouse gas emissions will peak this year, if I understand the story correctly. Now, the implication of that is that fossil fuel demand would also just generally be peaking out? Obviously, there's some intra-fuel dynamics. Maybe coal's going down, gas is going up, oil's somewhere in the mix. But Fernando, I always enjoy talking about this topic with you because it's fun, and I think we see it a little differently, which is great. But what do you make of this idea? Are we anywhere close to the idea that emissions could be peaking? Is it going to happen this year?
I'm not sure if it will happen this year. I think, again, if it does, it's no small part because demand is under pressure. I mean, you can ask Will about industrial demand in Germany or in Europe broadly being low, essentially because natural gas and electricity prices are so high. I think if you ask most governments, they don't want the current growth scenario to be the long-term baseline. So that would likely mean an increase in the consumption of primary energy, which then, in my view, it would mean an increase in fossil fuel demand, be that natural gas, oil, and in some cases coal. Um, I think the big challenge we have is balancing energy security and energy development with the other priorities on emissions, and especially when you look at China, that has especially energy security in their sites. They produce a lot of coal. They are large importers of both natural gas and oil. Will they give up their coal base in order to achieve emissions targets? And so far, it doesn't seem like they will. Um, but it could change over time. We would have to figure out a different incentive structure. But then, the struggle, especially in wind and offshore wind between Siemens, Ørsted, and others, uh, point to either a need for structurally higher electricity prices or for a need to improve the efficiency of renewables significantly in order for them to reach the goals that um, some of these climate tech companies have set for emissions. So I don't think that it's the peak, but I don't know that we're necessarily very far away. Just because we have made advances in decarbonizing the current infrastructure.
Scott, I want to come over to you on this topic because I recall, I can't remember if it's on this call specifically, but I know you and I have discussed the idea that some of the oil field service names want to be known as energy service names, very, very similar to some of the discussion that Will's had. Some of the European oil majors want to be energy majors. And so there's a sense the energy transition is a great part of the narrative or discussion at the moment. And so, Scott, where's energy transition fit within the strategies for some of your names?
Yeah, we still see, an emphasis on this with the oil field services complex and the majors, particularly for SLB and Baker Hughes. I'd say the biggest area of order flow for both those companies is probably carbon capture. I know there have been some cancellations in some of those types of projects recently and some questions with regard to the economics. And obviously that's very critical in terms of facilitating growth in other areas within clean energy. We saw Net Power, which is an emerging technology company that is a Rice Energy SPAC that got hit pretty hard about a week ago. They are Baker Hughes is a big investor in them. They're developing technology to develop an emissions-free gas-fired power plant. They pushed the start date back a year, and the stock got walloped. They're also, obviously, that's very critical in the hydrogen space in terms of supporting blue hydrogen, and there's been a lot of questions in hydrogen, Plug Power, obviously. One of the bellwether, if you want to call it, hydrogen names has gotten really crushed recently due to concerns about the economics of their business model. While we have seen some progress on the federal incentive front for hydrogen with the awarding of $7 billion worth of funding to support the build out of hydrogen hubs in the U.S. Half of those are expected to have blue hydrogen, of which obviously carbon capture is an essential component. And so I think, a lot of the focus here will be around carbon capture. Again, that's been the biggest source of order flow, certainly for Baker. Also a big focus area for SLB, Halliburton probably to a lesser extent, but still relevant for them. We probably have heard less talk in this area from these companies than we did a year ago. And we're talking single digits in terms of the contribution to the order book at this point. It's still nascent, but a relevant topic. But I think certainly this year it seems like there have been more questions and concerns than there has been progress on that front. And so I think carbon capture is an area to watch to see if we see some improvement in the technology and confidence and some of these projects moving forward, pipelines progressing, etc. But still certainly a key component of the business model story for these companies, although it secondary obviously to oil and gas.
Talon, I want to swing around to you. LNG is often thought of as this sort of transition fuel, and it's got a sort of bright future in many minds based on the role that it can play in decarbonization, particularly with offsetting coal and things like that. So what do you make? Where does LNG fit within the overall energy transition story here at the moment?
Yeah, I mean, I can talk to LNG and the pipelines as well, because the pipeline companies in North America also want to participate in the energy transition. I mean, their infrastructure can be used they're going to haul whatever product is in demand, and a lot of them are getting more involved with renewable natural gas from landfills and dairy farms and things like that. Obviously, it's such a small market, but the key with a lot of that is coal to gas switching, right? And in the US, I think coal still makes up about 20% of the energy stack. And we've seen in the US what coal to gas switching can do with emissions. And I think what LNG does is it pushes that to other parts of the world where, I think if I remember correctly, that China, about 60% of their energy stack is coal. So even if you displace a small part of that with gas, and then obviously other developing nations, some still burning biomass and things like that. If you can replace those, fuels that have so much higher emissions with gas, I think that it does. I still believe that it is a bridge fuel and can help immensely with decarbonization, getting to those developing nations. And if you have places like the U.S. that have the supply, right, and you can get it to those parts, that'll certainly help, displace some coal and cut those emissions just like it did in the U.S.
Okay, thanks, Talon. Will, I want to come back and swing around to you for the last word on this topic. We were on a call just before this one talking about the energy transition, so we feel like we've heard each other speak on this quite a bit today. But what's your latest read on the tea leaves? I'd love for you to weigh in on sort of just the topic of peak emissions, but also, where does this really fit within the strategy of the companies you're looking after at the moment? We keep seeing this ebb and flow about the rationalization between deploying capital to get return in oil and gas type investments, and then all the new energy stuff. What's the latest paradigm for European energy companies?
Yeah, so just quickly on your emissions question, I mean, I don't think we've hit peak emissions. If you pull up the chart, it certainly doesn't look like it. And of course, we're making massive progress in, renewable deployment, and we're going to see record solar installations this year. I think well over 320 gigawatts. But still, it needs to be chalked up beside what's going on in fossil fuels and particularly coal and power gen in China. So, which unfortunately is a large component of global emissions. And so, and also not to mention what Fernando said is that demand is still going to grow next year for oil and gas. So I don't think we've hit peak emissions yet, but that's not to say that net zero targets can still be achieved. And I think this is reflected in the next part of your question, which is what's going on in the European major strategies, which in my view, and I think is the conventionalism as well, is that the pace is slowing. The sort of trajectory of their emissions decline is getting pushed out rather than pulled in. There's more investment in oil and gas occurring to the end of the decade. That's not to say that lower investment is coming through on renewables, just higher over the interim for oil and gas, and it's very clear what management is saying, and especially reading through the lines, is that particularly for the Europeans, I'm not talking about the Americans here, but for the Europeans, it's hindsight's 2020, but they moved too fast and too far on renewable, particularly renewable power in investment, 5 years ago or beyond. The returns profile for these projects are just nowhere close to where they approve oil and gas projects at, and we are seeing that come through with what's going on in offshore wind, particularly in the U.S., seeing massive impairments from Ørsted. We're seeing those as well, from BP and Shell. So yes, the energy transition is slowing, and that's coming through on the strategy adjustments that we've seen from the Europeans, and also you could say that's being reflected in some of the M&A that we've seen in the U.S. with Exxon and Chevron making big oil plays. I think is a very unambiguous statement for how their management teams are seeing how the world's energy mix looks in 10 or 15 years, and that is resilient global oil demand.
Okay, I think we'll have to make that the last word. I want to thank everyone for joining. Again, we're doing these weekly now, and as we head into the holiday season, I think one of the things we'll try to highlight over the next few calls before everyone takes a break at the end of the year is the outlooks that we have for 2024. So, we've got a big team. Each person puts out their view on how their sub-segment within energy and the companies they look after, how things may shape up for 2024. So we want to have those discussions and make sure that you understand kind of how we see the world. Many of those are already either out or in the process of being rolled out. So make sure you visit BIGO on your terminal and read those outlooks, because they're certainly coming out on sort of almost daily basis. We want to make sure you see them, and we're happy to sort of bring that discussion here to this call as well. So look forward to being in touch, and I hope for everyone in the U.S., I hope you have a great Thanksgiving. We'll talk to you next week.